All right. Today is Friday, the 29th of April, and this is a Friday night special. Why do we have a Friday video? Because the market crashed, kinda, and we have a lot of panic and fear, so let's talk about it. It was a bloodbath across the board. Very few names to hide in, mostly moving higher based on earnings, but besides that, it was a massacre across the board. The market lost all of the important technical levels like they never even existed. No resistance at all. Now, what does that mean? No resistance at all. It means if you've been watching the charts intraday, for example, throughout the week, we see a rebound in the morning, everything looks hunky-dory, and then we see a flush down with no stop in sight, no buying, no resisting of the selling at all. So the volume was not responsible for the selling, meaning we did not see a mass liquidation event, for example. We're not seeing margin calls hitting, for example, in a mass scale. Otherwise, we would have seen the volume spiking higher significantly. So why do we see these flush downs on, let's say, slightly higher than average volume? The answer is no resistance. The buyers are not there. You see the selling happening and the charts kind of cooled down, finding some support, and the charts are looking for buyers. Any buyers, any buyers. And the buyers did not show up, so the sellers did, and we see the resumption of the selling. As if the action in the stock market this week was a one-way street, and that street was the sellers' street, and hence there is no resistance to stop the selling. What does that mean psychologically speaking when we talk about the sentiment? It means that we're seeing somewhat of capitulation, extreme fear, where market participants are saying, not buying here. I'm too afraid. I'm too afraid because I saw what happened with Netflix. I saw what happened with Teladoc, for example. I've seen what happened with other stocks reporting earnings and crashing right away. Although the sentiment got a little stronger after Microsoft's and Meta's earnings, we saw massive pops higher. And the buyers did show up. We got a decent day in yesterday's activities, for example. Then came Amazon after the bell, and you have a mega cap tech stock down double digits. Well, that's going to strike fear in the hearts of market participants to say, I'm just too afraid here. We have earnings bombing all over the place. We have what's going on with the war in Ukraine, and now it is evolving into an economic war, where Russia is cutting the supply of gas to European countries. We also have the Fed coming out next week. So the dip buyers are not as bold as they used to before. The dip buyers are saying, now I'm afraid. Now it feels serious. The dip buyers were kind of arrogant up to like 2 weeks ago. They were saying, you're just a perma bear. The stock market's going to go back to all-time highs. You don't understand. Tesla's this, Nvidia's that, Microsoft, whatever excuse they can come up with. But now we're not seeing that anymore. And hence the sellers are having their way. Now, that opens up the argument, well, isn't this a contrarian indicator saying that perhaps we should buy because we're seeing extreme fear? The dip buyers are finally broken. Isn't this a sign to buy? Perhaps. But here's the problem. When you talk about extreme fear as a contrarian indicator, and it is a sign to buy, for example, what is your target from buying? Is it going back to all-time highs? Because that's not happening. Is it just a mere rebound to a certain technical target? Because that could happen. Is it a trade for a day? That certainly happened throughout the week. We had very good trades, by the way. You buy them by the close, you dump them first thing in the morning. So the scope is important when we talk about extreme fear as a contrarian indicator to buy. If your goal is to go to all-time highs, good luck. But I think you will hear from the likes of Warren Buffett, for example, over the weekend, who's per usual going to strike a positive tone, an optimistic tone, doubling down in his strategy that you should hold in the long run, that investing in the long run is the name of the game. And that could excite the buyers on Monday. We see a rebound, and then the Fed comes out with the rate hikes, and we do the sell the room or buy the news, and the market rebounds higher. Yet what took place this week is extremely important because finally we got a confirmation that the bull market is dead. It's over. The bull run is done for good. We got a technical confirmation, not just the fact that the SPY, the S&P 500 is below the 200 days moving average. That was sign number one. But the confirmation came from violating the most important support at 4,200. Number two, we got a fundamental confirmation that the bull run is over. When we looked at big cap technology stocks earnings, for example, you can see clearly that they're facing a slowdown that we have not seen in over a decade. For certain companies, the biggest slowdown in growth in their history. Whether we're talking about Facebook or Netflix, you can see the top. The growth is over now. We hit the ceiling and it is a downward trend from this point on. When we looked at Amazon, we have a confirmation that the growth is slowing down dramatically. And we haven't seen this kind of slowdown in Amazon's business since the crash of 2008-2009, which leads me to the scope of this video. Are we right now in early 2008 or late 2008? Meaning, in the first quarter of 2008, we got the initial shock. And then the crash came later that year. So what do we see here in the stock market that we have right now? Here's a weekly chart for the SPX, the cash index for the S&P 500. When we talk about violating the most important supports, the fact that we have a technical confirmation right now that the bull run is over because the chart is below 4,200, the most important support. And this is, by the way, a weekly closing below 4,200, so we know it's gone for good. But so far, since the top in January in this year, the SPX is down around, let's say, 15%. Now, keep that in mind, but let's go back in time and revisit 2008. The top was in October of 2007. That's when the S&P 500 topped. And then, since that top, the stock market went down by around 20% before it rebounded higher again. So all the way for the first quarter in 2008, and some of us remember that time, it was kind of concerning. We got concerning economic news. We got concerning sell-offs in individual stocks. But it was not panicky. It was not the end is here. But we were starting to get concerned. The sentiment was eerily similar to where we are right now. Then came the crash in 2008, October 2008 to be precise. And the crash is different from the initial shock because in a crash, you cannot catch a break. The indices flush down in a massive way. And we see the stock market losing 20, 30, 40% rapidly in a short amount of time. So in a crash, you cannot even catch a break. There are no rebounds. It is just a one-way street. In an initial shock, you get rebounds. You get consolidations. You get some hopes of going back to the top again. So the question that I present to you right now, the viewers of this program, where do you think we are? Are we in the initial shock or are we in the crash? Are we in the first quarter of 2008 or are we in the fourth quarter of 2008? The answer to this question relies in one important commodity, and this commodity is oil. You see, here's the weekly chart for Brent crude oil back in 2008. The S&P 500 topped back in October of 2007. But look at what happened here. Oil continued to move higher. It did not top at all until July of 2008. Once the top in oil happened, we saw the rapid unwinding of the inflationary run in oil. Then, a few months later, in October of 2008, the S&P 500 finally gave up and broke down in a crash. Why is oil an important indicator? Why can't we have a crash without a crash in oil? Because oil is, number one, a pulse of demand on the global economy. If oil continues to move higher, then the health of the global economy is still intact, the demand is still here, and we seldom see stock market crashes and the demand in the global economy is intact. And when we see crashes in the stock market amidst a strong demand in the global economy, these crashes are short-lived. They recover right away. They happen to be flash crashes. But what we're talking about right now is the everything bubble unwinding. And this will not happen if crude oil continues to move higher, because crude moving higher is an indicator that we still have demand in this economy. Hence, the stock market will not crash unless we already have a top in oil. Here's the weekly chart for oil right now. Does it look like we have a top? Does it look that oil is about to crash? And hence confirming that we are indeed about to crash in the S&P 500? That this is not the initial shock stage, that this is the crash stage? Well, that's up for debate. We have a negative divergence on the RSI. We have an imminent crossing in the MACD indicator confirming the negative momentum in oil by producing red impressions in the histogram. But that doesn't mean that oil has to flush down. That could mean that oil might be consolidating for now. Matter of fact, oil could move higher from this point on. The weakness in the momentum indicators doesn't mean that this is the top. The top happens in clear candlestick patterns, number one, and after violating important support lines. Neither of these things happened in the chart of crude right now. Another important point here, and it is not technical, it is fundamental. If the Chinese economy opens up right now, if the draconian lockdowns are lifted, we will see the demand for oil moving back up higher again. The Chinese government is already stimulating the economy. But the fundamental argument aside, when we look at the technicals, one cannot say that this is the top for now. It was clear back in 2008. We had a topping candle and the confirmation came right away. This is not what we're seeing in the chart of crude oil right now. Another important point, when we use the Fibonacci support levels in the chart of the S&P 500, the SPX, the cash index, from a weekly chart perspective, the chart already violated the first Fibonacci support. But again, is this the crash or is this the initial shock? Because if we go back to the SPX chart back in 2008, the crash did not happen until the SPX violated the second Fibonacci support. Matter of fact, the initial shock resulted in violating the first Fibonacci support. We went down to the second Fibonacci support, and the chart made a double bottom and it rebounded higher from that point on. As a matter of fact, it recaptured the first Fibonacci support. And then came the violation of the support once again. It did not last for too long, marking a lower high on the chart, and then it went down to the second Fibonacci support. It did not catch support from that point on. It violated the support once, it reclimbed it again, and then came the confirmation that the second Fibonacci support is not going to hold. And then the crash happened. So the technicals are important. We seldom see crashes in one shot right away. The pandemic crash in 2020 was the exception. But if you look back at the crashes of '08 and the dot-com bubble, it was a process, starting with the pullback, then the initial shock phase, and lastly, the crash. So what we could see here, and this is not a prediction, by the way, I'm just saying, we could see sell the rumor, buy the news, the Warren Buffett optimism next week. We see the chart recovering the Fibonacci support right away. We see consolidation for a little while, and then the chart violates the support, going down to the second Fibonacci level. It rebounds from that point on in an attempt to recapture the first Fibonacci support, and that could be met with failure, and the chart goes back to the second Fibonacci support once again, and then that breaks and we see the crash perhaps in the fourth quarter of this year. Again, this is not a forecast. I'm just saying, if the crash that's about to happen in this run is similar to 2008 and the dot-com bubble, then it will be a process and it will be only confirmed after the top and the beginning of the crash in crude oil, indicating that the global economy is indeed falling apart. And this will happen. This is a forecast. We talked about it before, that the global economy will fall apart. As the Fed starts to tighten, we see the global demand slowing down, commodities start to crash, and then we see that crash, that one flush down in the stock market. Furthermore, in the most recent inflation run before this one, in the 2007-2008 episode, the market did not crash until commodities started to crash. Corn, natural gas, wheat, etc. Are we seeing these commodities topping right now in this run? Well, here's the chart of corn. I don't see a top here. I see corn blasting higher. Perhaps this is the last hurrah rally. When we look at soybeans, for example, not seeing a top here. Maybe it's going to happen, but we're not seeing it right now. We're not seeing a massive reversal where we could say this is the top. Commodities are crashing. Watch out, the stock market is going to crash next. Soybean oil, no top here. Cotton, I don't see a top here. Similarly, coffee, maybe we have a top here. We have yet to have a confirmation for the top. Likewise, here's natural gas. Do we see a top here? I'm not seeing a top. Natural gas continues to move higher. So when commodities are moving higher, indicating that we're still seeing demand in the economy, we're still seeing the inflationary pressure in the economy, then perhaps we are in the initial shock stage, not in the crash stage this time around. Meaning we are in early 2008, not in late 2008. That will happen. That will come. But perhaps it is not right now, even though it kind of feels like it. But the evidence so far doesn't support that this is the crash. And this will make the chart of crude oil the most important chart to watch out from this point on. If the chart violates, for example, an important support of 97, then we can comfortably say, hey, we got a top in oil. And now we're seeing significant unwinding of positioning in crude oil. We will know right away that the crash in the stock market is next, and we will liquidate the entire portfolio. All the long positioning will be gone, and we will initiate a short on the index itself, because at that point it will become clear the stock market is crashing, and the crash will perhaps take us all the way down to erase the entire gains of the pandemic. So my take for now is, I think we are in the initial shock stage, not in the crash stage. But let me know what you think in the comments. Is this it? Is what we're seeing right now the beginning process of the crash, and it's not the initial shock? And why do you say that? Whether you think it is the initial shock or the crash, let me know in the comments. And of course, I'm going to produce some videos over the weekend, perhaps tomorrow. We'll lighten up the mood a little bit via phone calls. Some of your favorite guests will be phoning in, from Russian President Putin to former President Obama to Dr. Fauci. Maybe Reverend Elon will call. So stick around and keep an eye on the channel. But for now, this is all I got for you for this video. Thank you for listening. Thank you for watching. I will talk to you again. Have a great weekend.